Welcome back everyone, I hope you're doing well, and in this video, we're going to discuss 4 stocks that analysts from Bank of America believe are buys in the second quarter of 2021. The big bank shared a list of companies that they believe will continue to climb past their current level and to new all-time highs over the next 12 months. And the entire market may be getting a boost in the second quarter as analysts are projecting an economic boom to occur over the next 90 days. So in this video, we're going to take a look at 4 stocks included in Bank of America's list that they have ranked as a buy now. And for each company, we're going to go over their current financial position and their future expected growth. But first, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy, and any major market news. So please hit that like button, subscribe for the daily videos, and today we're going to focus on 4 stocks that Bank of America has listed as big buys in the second quarter of 2021. And the first stock in this episode is ticker NEM, which is the Newmont Corporation. They currently trade for $61 per share, and over the trailing 12 months, they have grown by over 33% and now sit at a market cap right around $48 billion. And this company has a current dividend yield at 3.5% and is trading at a very reasonable forward PE right around 16. And this is actually a gold company, and Bank of America believes they will continue to climb to new highs over the next 12 months. And the Newmont Corporation does own some very strong assets located within North and South America, and they are considered one of the world's leading gold companies. And over 2020, they performed extremely well. If we take a look at the full year results on the right-hand column, their total revenue climbed to $11.5 billion, which was up 18%. Their adjusted net income was up 121% over the trailing 12 months, and their adjusted cash flow, which is really a very strong metric to evaluate the health of a business, was up 173% to $3.46 billion in 2020. So we can see that their recent performance in 2020 has been absolutely incredible. And as the company continues to perform well, they return capital to their investors in the form of a quarterly dividend, and that grew 250% in 2020 over the fiscal 2019 number. So the massive boost in their cash flows, they actually returned that capital out to their shareholders in a very massive boost to their annual dividend. And if we take a look over the longer term, they continue to grow revenue each and every year to a record high of $11.5 billion in the trailing 12 months, and the company's total net income has been growing as well to over $2.8 billion in 2020. And if we take a look at their dividend, right now, after their latest payment, they have a yield of 3.5% and a payout ratio that sits at 57% of the company's total net income. And if we take a look, going forward throughout 2021, analysts are projecting a 42% growth to come from ticker NEM, and the current share price of $61 is well below the 12-month target of over 73, and they are currently considered a buy, coming in at a 2. So definitely take a look at Newmont. They were included in Bank of America's buy list for the second quarter if you want some exposure to the gold sector. And now we're going to move on into stock number 2, which is ticker DIS, the Walt Disney Corporation. They currently trade for $189 per share, and on the 12-month chart, the company has grown by over 99%. And at this current level, they're trading with a $334 billion market cap, and Disney has been one of the most interesting companies over the 2020 year. Because of the pandemic, they were forced to shut their theme parks all across the world, and that lost them over 10 to 15 billion in annual revenue. Plus, the company just announced the launch of their Disney Plus service, which has absolutely exploded in popularity and has really transitioned the entire company's future. But recently, they just got some good news that as of April 30th, they're planning to open up their Disneyland parks, and that is a new trend that's projected to come back over the next 12 months. And as vaccines continue to get distributed all across the country, and it's safer to gather in larger groups, Disneyland is a place that's poised to benefit from further economic reopening, which is going to be great for the company's total top and bottom line. So they're projecting that Disney over the second quarter, with Disneyland starting to reopen and more attractions becoming available to consumers, is going to get a major boost to their revenue and post some very strong numbers. And also, we have to talk, of course, about Disney Plus, their streaming service, which is absolutely incredible. They're coming out with new content all the time now, has topped 100 million paid subscribers in only 16 months after launch. So it took Netflix years and years to hit 100 million subscribers, and Disney did that in less than 16 months. And the company is now projecting to cross 230 to 260 million subscribers by year end 2024. So I think Disney going forward can still be worth a lot more than the 330 billion that they're currently trading at right now. They're sitting at this level even without the theme parks being open right now. But let them reopen over the next 6 to 12 months all around the world, I think the company's total revenue will continue to climb to new record highs. And if we take a look at their income statement, we can see that in the trailing 12 months, they generated around 60.7 billion of total revenue. And of course, that number is still down from their 2019 high of over 69 billion. But if you think about Disney's businesses, the fact that they could still generate over 60 billion of total sales when their theme parks were shut down, their cruise lines were shut down, and their restaurants and their retail locations all across the country were shut down. So the fact that 3 other main business segments were forced to shut their doors and the company was still able to generate over 60 billion of total revenue, I think is extremely impressive. And let's see what happens over 2021, 2022, and 23 as the theme parks come back, as the retail locations open up, and the cruise lines go back to full operations. And we'll see how fast this company's total revenue continues to climb, and I think over the next 3 years, we will actually see them cross that $100 billion mark in total annual sales. And if we take a look at their balance sheet, just because there is some uncertainty over their operations for the next 12 months, because we're not fully out of the pandemic just yet, the company has around 34.8 billion of total current assets compared to short-term debt at only 26 billion. So right now they do have a current ratio nicely above 1, so over the next 12 months, their financial position is very strong. And if we take a look at some future growth projections, over the next 5 years, they're projecting over 48% per year share price appreciation to come from Disney. And at this current level, the company trading at 188 is below the 12-month price target of $206, and they are considered a buy, coming in with a 2. So of course Disney is one of the largest entertainment companies in the world. They're known worldwide. They have some of the strongest intellectual property to ever exist. And I think this is a brand that's going to remain operational for decades to come. And the company's whole vision has completely changed by the success of their Disney Plus streaming service. So although they are trading at near record highs, Bank of America has included them on their strong buy list for the second quarter of 2021. And now on to stock number 3, we have ticker ORLY, which is O'Reilly Automotive. The company currently trades for $508 per share, and from the March lows, they have grown over 76% and now trade with a market cap of $35.4 billion. And at this current level, they're trading with a forward PE of 21.5. And this is a company I actually agree with Bank of America and do believe they will continue to grow at a very fast rate over the second quarter for many different reasons. But first, I believe that after the stimulus checks have been deposited into consumers' bank accounts all across the country, they're going to spend the money on the upgrades that they were previously holding off. And now with more individuals than ever having personal vehicles instead of public transportation due to the pandemic, I think the need for auto parts sales, and everything related to this industry is only going to boom because now individuals who have cars that previously didn't, because they used to use public transportation that really isn't the most safe and viable option at this current point in time, are now owning personal vehicles. And all these individuals who had to spend the money on personal vehicles up front during the pandemic didn't really have the cash, survey shows, to actually upgrade it or spend the money to get everything fixed at the point of purchase. But now, with this extra $1,000, $2,000 in their bank accounts, it may be motivating to get those upgrades, fix up their vehicle, because they're planning to drive it for many years in the future. And O'Reilly Automotive is poised to benefit from this increase in consumer retail spending. And if we take a look at their latest investor presentation, the company has done a terrific job of continuing to expand their network of stores even throughout the 2020 pandemic. And at year end, December 31st, 2020, they had around 5,600 stores in operation. And even throughout the pandemic, they increased 155 total locations all across the country. So I'm a big fan to see the company continue to expand their network even throughout one of the toughest times for market expansion. And if we take a look, 2020, they actually saw record high sales of over 11.6 billion, diluted earnings per share hit a new record high of over $23, and their return on invested capital came in at over 48%. And now if we jump onto their income statement, we can see that each and every year, total revenue is climbing to new highs, and they reached 11.6 billion in year-end 2020, and we can see the trend is going in the right direction. And if we take a look at their net income, we can see a very similar mark each and every year, climbing to new highs and reached 11.75 billion over 2020, and that trend is going in the right direction. And going forward, for the next 5 years in the future, analysts are projecting 10% annual share price appreciation, and at this current level, the $508 is below the $540 12-month price target, and the company is considered a buy, coming in with a 2.1. So if you believe the automotive sector, and especially the auto parts retailers, are going to see a boost with consumers having extra discretionary income and the economy starting to reopen and public transportation going down dramatically, then this is a brand to take a look at on the market right now. And now we're going to move on into the fourth and final company on Bank of America's buy list for the second quarter of 2021, and that is ticker SYK, the Stryker Corporation. They currently trade for $242 per share, and from the March lows, the company has climbed up over 67%, and they currently trade with a market cap at $91 billion. Right now, their forward PE comes in at 26.7 and a dividend yield slightly above 1%. And over the past 5 years, this company has been a steady performer, growing 124% overall, and a very nice recovery from the decline they saw back in March 2020. And this company operates in the medical technology sector. They generate 45% of their revenue from medical surgeries, 34% from orthopedic sales, and 21% from neurotechnology and spine products. And right now, 73% of their revenue does come from the United States and 21% from the developed international market. And overall in 2020, they generated over 14.4 billion in total global sales. And over the past 5 years, this has been a top dividend company. They've been raising that annual payment by 10.8% each and every year since 2015, and their adjusted net earnings are growing at 7.7% each and every year. And if we take a look at their actual financials, back since 2016, every single year total revenue was growing at a very nice rate, where they reached a high of 14.8 billion in December year-end 2019. Then of course the pandemic happened, and the company only saw a very slight decline in total revenue of only a few percent. And when most companies saw revenue declines of 20, 30, or even 40% overall, the fact that this company lost less than 5% of their total sales really shows how strong and how operational the medical technology products can be, even through one of the worst economic downturns we will ever see in our lives. And if we actually take a look at that dividend, like I mentioned, they have a yield at 1%, and their payout ratio only comes in at around 28% of their total net income. So it is very low and actually very sustainable, and they have a lot of room to continue to grow that payment each and every year going forward. And like we saw, over the past 5 years, they're averaging over 10% annual dividend growth, with a growth streak right around 11 years. And going forward, like we've done for all the companies, their future growth projections include an average estimate of over 12% per year share price appreciation, plus that 1% dividend. You're looking anywhere from a 12 to 14% expected growth rate coming from SYK for the next 5 years. And right now, the company does come in at a 2.2, meaning they are considered a very slight buy, slightly below the buy mark, and the current share price of $243 is just below the 12-month price target of $253. So this is a company that doesn't really get a lot of love on the market. It's somewhat overlooked, but over the longer term, they have been a steady performer. They've been growing their earnings and their dividend payment. And if you're looking for kind of a healthcare company that isn't one of the big names, this company is included on Bank of America's buy list and maybe an interesting name to pick up in the second quarter of 2021. And now we're going to wrap up the video. We took a look at 4 companies that Bank of America has listed on their highest conviction list for the second quarter of this year. And with the economy expected to boom over the next 90 days, now would be a great time to pick up some companies. Even though they've already seen some bigger run-ups, doesn't mean they're not going to continue to climb to new highs going forward. So thank you for watching to the end. I am the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy, and any major market news. So please hit that like button, subscribe if you already haven't done so, and I will see you in tomorrow's episode.